Hello everyone, welcome to the Stock Trading Tutor channel. In this video, we'll be looking at how you can use the Renko charts. So first, let's see what a Renko chart is. This is a type of chart developed by the Japanese that is built using price movement rather than time or volume. So Renko is thought to be named for the Japanese word for bricks called as Renga, since the chart looks like a series of bricks. A new brick is created when the price moves a specified price amount, and each block is positioned at a 45-degree angle up or down to the previous brick. An upward brick is typically colored as white or green, while a downward moving brick is typically colored black or red. So here is a example chart of how the Renko chart will look if you apply it on the Nifty's daily chart. So we say this is a daily chart, but generally, since the Renko chart is not based on specific time, this is based on price movement and not specifically on time. So what you see here is showing is not based on time movement. Each brick here does not represent a day. It just represents the price movement moving upwards or down. So Renko charts are very effective in identifying key support and resistance levels since there is a lot less noise than a candlestick chart. Trading signals are typically generated when the direction of the trend changes and the bricks alternate colors. So here we can see when the trading colors change from green to red, it creates a signal, and when it moves from red to green, it creates a signal. However, when the market is a little volatile, it can create lots of signals, and that can be a little confusing and should be avoided. However, otherwise, it generally gives good signals, as we can see here. If you start trading when the color changes, sometimes you can generally get good trading bullish runs or bearish runs the time, based on the price movement itself. So Renko charts use closing prices. So the first step is to define the price range. You have to use a minimum amount of price move necessary to draw a Renko brick. The rising lines are denoted by equal sized white or green bricks, and the falling lines are denoted by equal sized black or red bricks. So rising lines, that is, the bullish runs, are signified by green bricks, and when it is in a bearish move, it will be in red colored bricks, as we have seen in the charts. So let's look at some of the characteristics. Renko charts are based on bricks with a fixed value that filters out small price movements. So if suppose we have a specific movement of at least 10 points up or down, then the price will not show. There won't be any new brick created if there is a price movement of just 5 or 3 points. A regular bar, line, or a candlestick chart has a uniform date axis with equally spaced bricks, weeks, and months. This is because there is one data point per day or week. Renko charts ignore the time aspect and only focus on the price changes. If the brick value is set at 10 points, a move of 10 points or more is required to draw another brick. Price movements less than 10 points would be ignored and the Renko chart would remain unchanged. So Renko charts can be based on closing prices or the high-low range by using the field setting in sharp charts. So closing price means that there is one data point per period and less volatility. The high-low range puts two data points into play and increases the fluctuations, which results in added bricks. So here we have a Renko chart based on closing prices. So 10 points per brick or a block. So here we have the black and white chart. So white it shows the rising lines and the black shows the falling lines. So when there's a price movement of 10 points or up, we can see a different brick being created. In this example chart, we can see. So each white block here increases a 10-point upward movement, and the black bricks here means that it's been falling steadily for 10 points in each movement, more 10 or more points in that time period. So next we have the high-low range. So with high-low range, again we can see the 10 points per brick or block. So each 10 points there will be blocks. Here, if there's 10 points or more, it'll be generally just signify one brick for that day. If there's no movement, or it's like less than 10 points movement, then there won't be any brick at all. And here it's a movement of 10 points per brick. So if there's like 10, if the stock specifically moves about 30 points, there'll be three bricks created here, regardless of the time. So as you can see in the charts, downward the x-axis, we can see the date, the timing is kind of irregular, and the dates are not equally spaced out. So that is the high-low range. So let's see how the trading signals are created. So it's quite simple. So you can buy when the white bricks appear. So this is white bricks or green bricks. So when there's an upward movement, you can buy the stock. So generally when the white brick appears after the black bricks, that is a buy signal. And you can sell when the black bricks appear after the white bricks. And so this is quite simple and creates a easy to understand trading signal. So if the market moves up more than the amount required to draw one brick, but less than the amount required to draw two bricks, only one brick is drawn. For example, in a 2-unit Renko chart, if the base price is 100 and the market moves 103, then only one white brick is drawn from the base price of 100 to 102. The rest of the move from 102 to 103 is not shown on the Renko chart. The same rule applies anytime the price does not fall on a box size divisor. So here we have an example given here. So this, whenever the green block changes from green to red, here we have a sell signal. And here once after it finishes its downward movement and starts creating green bricks, this is the buy signal, and you can just buy whenever there's a brick color change, making it quite easy to understand the trading signals. Here, however, there's a slight misunderstanding. This is one slight false move. As you can see, it's an overall upward movement with one sudden downward drop. So we should be a little wary of that. Along with the Renko chart, you can also look at other candlestick charts and indicators to create um, more confirming signals so that you can trade with better understanding of the up movement of the chart. Now let's look at some of the advantages of the Renko chart. So charts are price based and the time is ignored. So with intraday Renko, there may be hours between bricks creation, and a trader must be very patient in this case as the trend has paused and become very choppy. Long-term trends can be seen much easier when using this type of chart. Supply and demand zones also seem to be more visible when you use the Renko chart. When you are trading, always trade in the direction of the dominant trend. So if you look at the chart, you can see it gives you a consistent trend, and you can trade safely when you safely as in considering the risk taken and avoiding the false signals. You can generally trade based on the movement of the chart, as this is generally depends only on the price, and the chart is very price based. So thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to start trading in the stock market, you can create your Demat account with Alice Blue. Just click the link in the description and fill out your details, and you can create your Demat account with Alice Blue. With Alice Blue's brokerage services, you'll get excellent exposures and margin for trading in the stock market.